Today was a very big day for the markets. We had Janet Yellen testifying. She's going to be testifying again tomorrow, so I guess whatever she didn't impart today, she will impart tomorrow to a separate committee. So her notes, her prepared statements were released early today, and we had a nice little rally in the futures in the morning. Japan, I think, was down again. Oil had been opening under a little bit of pressure, so that wasn't helping, and you had this little bit of a gap up in the market. China, as we know, is closed. So the problem here for me with Yellen, and I listened to her testimony quite extensively, I think the big news today was the Black Caucus members basically telling her she's a racist, an elite white racist for raising interest rates, which was actually kind of comical. But anyway, the point is that she is still sounding. Everyone seemed to think she was dovish. I actually read it the other way. I read it as them being intransigent, that they don't want to admit they made a policy error. I think to anybody at this point, it's clearly and clear and obvious that they did. She gave her a cap tip to the deteriorating economic conditions, which I think was warranted. She did say, though, that she still sees growth. I guess that was sort of not, wanting to get everyone too nervous, not screaming fire in a theater. But the only problem is the theater is actually burning. Global economic growth is really not doing well. We have really crappy economic numbers. I've discussed the unemployment number to people in the past, that I think it's a bunch of temporary hires. It's low quality jobs, and any wage growth has come basically off minimum wage increases. I'm just looking for my standard rap sheet here. That the GDP, so here's the problem. The Atlanta Fed raised, I knew we were going to be dead to rights today when the Atlanta Fed the other day raised their, they raised their GDP estimates from 1.1 to I think it was 2 or 2.2%. I have to take a look. But the Atlanta Fed has been all over the place. They're raising, they're lowering, they are wrong. They seem to always get it wrong, these guys. It's amazing, everyone wonders why these Greek bailouts and, these structures never seem to work out, and it's because all of these central bankers, central planners, central bankers, they make the same mistake. They overestimate growth. They assume it's the same thing with analysts. They assume stocks can go to the moon, or they're going to go to zero. There's sort of no in between. And these guys don't realize that there are structural problems in the global economy, domestic economy and global economy. Globally, I've discussed that their problem was energy prices being too high for too long. They also have structures that are unrealistic with regard to entitlements, like retiring at 55 in Greece. But the problem here is that the jobs picture is not really getting better. It's a lot higher than they're willing to admit. That 4.9% or 5% is supposed to be, quote unquote, full employment with enough slack in the labor force for businesses to hire. The problem is that model is sort of broken. I think a lot of it has to do with Obamacare, with companies hiring people part-time as opposed to full-time to avoid the tax. It also has to deal with corporate inversions, because we have the highest tax rate in the world and companies are moving overseas, as well as offshoring. They are outsourcing to India and China and so on and so forth. I challenge you to call customer service and get someone who really speaks English in their native tongue, or at all, for that matter. Not to be too flip there, but it is sort of is what it is. We have some other, the other economic reads, the ISMs, the service and the manufacturing have been horrendous. The PMIs have been horrendous. The durable goods orders have been horrendous. What had been propping that up was autos and aircraft, but those are really dependent on a good economy and low interest rates. And the airplane numbers we know from the Boeing have been cut tremendously. The other issue has been the strong dollar, which did back off a bit today. It had been stronger earlier and backed off, and that has wreaked havoc, we know, on corporate earnings and commodities, which leads me to oil. You know, the Fed keeps saying that the decline in energy prices is transitory. So they said that in the 50s, the 40s, the 30s, and now we're in the 20s. You know, that's the kind of stuff that should warrant its own congressional hearing. And, you know, that's kind of like, if you were talking about the, like, let's say the London whale, this is like the equivalent of a London whale type of a bet. I mean, they have been so wrong for so long on earnings, on energy prices. It's kind of scary. I think that got started under Bernanke. He was quite prescient with his calls, but Yellen, I guess, isn't as good of a trader, or at least the markets didn't want to cooperate with her so much. I posed a question the other day that was, I don't have the exact numbers in front of me, but it was talking about has Yellen, how much credibility has she lost? And honestly, the two top answers was major damage and that she has lost all credibility. My answer to that was, I think it's severely she's severely damaged. I don't know if she's lost all credibility yet because we haven't quite gone into a tailspin, although the market is rather weak. I have said in the past that the big problem I thought that the Fed, that the markets face, is that I believe when the Fed raised rates, they all sat down and they came up with a number, and or at least a ballpark of what they knew the markets would probably react adversely to the rate hike. The problem is that we haven't acted adversely enough to cause them to back off of their stance. They're still going to talk tough, and they're still going to keep rate hikes live. I believe today the potential for a March hike went from 7% to like 12% or 14% or whatever. It's still rather low. I really, really hope that they don't do something stupid like go again. If they do, we saw what happened the first interest rate hike. You can basically take that projected move, that 200 points in the S&P, take it from the low and project it down, because that is likely what is going to happen. So that would take us to the breakout levels that I've been discussing, the high 1500s to low 1600s, to retest the 2007 peaks. We'll see how that plays out. That isn't a fait accompli. It doesn't have to happen, but the way things are looking, it's certainly looking like that is very likely the case. So we've had some interesting developments in stocks between here and there. We've had we've had oil week again. That's been a problem. We've had, what's crazy is that ever since the Fed said that they were going to raise interest rates have just gone completely lower. I mean, they have plummeted. And I think that's what's really getting people nervous about there being a recession of some sorts. If not, we're in one, it is potentially lurking. My view on that is that we are probably either dipping our toe into recession currently, or that we are like really close. I don't know if we're full blown in there, but the numbers suggest that we're dangerously close to a recession based on the economic numbers that I've discussed with you guys, and some other proprietary ones that I don't always discuss. You gotta have your limits somewhere, right? You can't go into absolutely everything. Anyway, with regard to the keys that I look at, there are 6 keys that I often discuss: the VIX, the dollar, the bonds, the oil, China, and biotech. Actually, let's just go through those for some good, some good quick housekeeping. With regard to the VIX, where did we close today? It closed. What the hell happened to my my indicators here? Unbelievable. All right, something I just love when my charts get messed up. All right, where did we close? 26.29. Not good. You really need to be below 25.20, or crash risk is still on the table. So that is a negative. The dollar. As evidenced by UUP, we had a gap fill and then closed weak. So the good news is for the best news for the well, it's a double-edged sword, I should say. It's not the best news. It's sort of the best of times and the worst of times. The best of times meaning that this will be a lot of pressure off of corporate earnings. The bad news is that this isn't going to be pressure on the Fed to not go again. They're going to think that the dollar move is transitory and that it's okay. You know, they're looking at outdated, in my view, data, economic indicators, and they're not factoring in some stuff that really matters. They haven't gotten global, really, in their view. They're starting to, but they're not there yet. So that's the story with the dollar. Bonds are absolutely screaming. They almost closed at the high of the day today. Just to put this in perspective, and if you've watched my videos before, you'll know these levels well, but 123.15 was the 2009 peak in bonds, meaning that when the world was ending, when all of these institutions were potentially closing, Lehman Brothers was going bankrupt, Bear Stearns was going bankrupt, we were like a second away from Citigroup going under. The price of bonds, a level of fear that people were placing on bonds is worse now than it was then. That is not a healthy economy. That is a disaster. A lot of the strength in bonds I know has been QE, and they haven't really ended QE no matter what they say. They still are doing the reinvestment. So the bond, there is an underlying bid to bonds. I think also one of the reasons why treasuries are high that the TV guys don't talk about because they're not real world people, is the fact that Europe is weak, Asia is weak, and these countries don't really have FDIC insurance. So what these people do is they buy the dollar, they change their currency into the dollar, and then they buy bonds. Because they're not so much worried about a return on their capital, they're worried about a return of their capital. So I think that has been what people have been doing. I'll tell you, I've said this for a while. Low interest rates are great for stock PE multiples. The problem only happens is how you get there. And the way that this is moving, the spike in which bonds are trading, is telling me that the market is pricing in recession. That is just simple. If you're looking at this, we're making higher lows, higher highs. It looks like it's going to retest the all-time high, actually. It very well may. We are coming into some resistance up here, though, which is good to note. I don't know if I would be first chasing TLT up here at 132s, although, let's see, the old high there was 132.76. Today was 132.84. The close was above. So, yeah, we might be going to the 138s. We might even be going higher. I've drawn in an older channel, and if this were to kind of just go in a straight line, I mean, that could take us to 143 for crying out loud if it happened in short order. So that's going to put a bid, obviously, on dividend stocks, the utilities, the safe haven stocks that people fly into for yield and will buy for recession. Those stocks have been doing well. What has not been doing well are the high growth stocks like your FANG. A lot of that, yes, is selling from people didn't want to take the tax hit last year, so they just waited and decided to flip out this year. And I saw after hours that Amazon is doing a big buyback or whatever, but let's just go through these for a minute. Other than Facebook, all of these stocks have gone straight down after their earnings. Facebook went up. It had a couple of days higher, and then it pulled back, but this is still typical price action for Facebook. It tends to run up into the earnings, run a little more, and then has these pullbacks, consolidations, a break to freak everyone out, and then runs again. So Facebook, I still believe. Longer term, I'm bullish. Shorter term, I'm just a little bit cautious. We'll just leave it at that. Amazon has the buyback. I think last I looked, they were hovering around 500. I think they were like 503. Let me see where we are now. It'd help if I could type properly to get my charts up. Yeah, it's backed off a little. It's up about like $7 or $8. Amazon broke one trend from the big gap that got everything going. It still has a primary trend, a significant amount lower. The buyback will probably hasten, or I shouldn't say hasten, it should blunt the decline a bit. But I don't think that this is a good idea for them to first be buying back stock here. You're into some reference levels. I'd prefer if they did this if the stock got much, much lower. These buybacks always seem to tend to be mistakes. They waste capital. I'd rather see these guys invest in their infrastructure or growth or buy something, for crying out loud, than spend $5 billion just buying back their own stock right here. Yep, it's down a lot, I get it, but I still wouldn't be doing a buyback. Netflix, I think Netflix got a little bit of a bump today, although I don't think it closed so stellarly. Let me just take a look. Netflix. Yeah, it closed up a little bit, like $2. It had been much higher. It was, wow, yeah, it even got to 92. The breakdown was really 90. I have 93.55. That was the 10.14 after hours low, but really the break below like 93s really anywhere below, into the 93s really was the breakdown. So it doesn't surprise me that there was some responsive selling. I think that the reason why it was stronger earlier was that Time Warner did crappy, and so did, we know Viacom has been having problems. Time Warner has been did terribly, as did Disney. Disney is looking very toppy. Anything below 90, I'll tell you, is signaling to me that there is a double top, a failed double top, and that stock could go, a lot lower. Let's do Netflix. Let's finish up on Netflix, and then we'll segue into Disney. Phone call coming in, and I hope I'm still broadcasting. Hope I'm still broadcasting. Yes, I'm still okay. Sorry. Yeah, they have to figure out something on Periscope, how to stop phone calls from interrupting Periscope broadcasts. That's it's not cool. Anyway, with regard to Netflix, it looks a little toppy to me. It also looks double top-ish. I've said for a while that I think this thing could fill, the real breakout was at 70, and primary trend, if it were to go there like immediately, would probably come somewhere between 63. So I think really between 63 and 70 is where I'd be more interested in buying there. It doesn't mean it's going to go in a straight line, but it would not surprise me to see it get back to those levels. I saw one of the firms come out and say they thought it could go back to 45, which is really where that would be at 100% retracement of the entire move. If we're in a true bear market and we're going to go back into like the 14 and the 1300s, we will absolutely see that number in my view. I don't know that we're in that bit of dire straits just yet. A lot of people, and I'll tell you, I've made this mistake myself. They assume end ranges happen immediately or even at all, and they don't factor in other levels in between there. So I will say this. It's sort of an if this, then that for me. It always is. We are still kind of holding into some levels that, and I will discuss that when I get to SPY, that although I'll tell you the picture is looking more and more bearish. But that is my view on Netflix. Anything that is below the 93s, let's say the downtrend line, even the 20 MA, is to me still vulnerable. With regard to Disney, that to me has a lot of potential weakness to it. If it can get back up over 90, it can start, I guess, starting to heal. That would neutralize the decline a bit. But it does have a trend break. It doesn't really have a check back, so it wouldn't surprise me to see a bit of a check back. But I have projected some Fibonacci extensions down, and it would take you to a big gap fill in the 71s. There was a breakout at 67.89 and the 61A to 64. So I think somewhere in the low 70s to mid 60s is possibly in store for Disney, as long as it's below 90 bucks. If it gets back above 90, I would say that the pattern neutralizes a little bit and you need to wait for another break below 90 for that. As of now, we are closing below 90, so there is vulnerability. Really very simple. Google reported a pretty solid quarter. It was up a lot after hours. It stalled regular trading hours, affectionately known as RTH, just below the channel high, and now we are roughly mid-channel. It's given back all of the earnings gains and then some, and there is a potential move to the channel low. I don't think it's going to be a straight line, but if it were to happen sooner than later, there is a potential that it would coincide with some reference lows and a prior reference top around 615. If it happened tomorrow, it would be a little bit below there, but I don't think anyone is thinking we're going to get another close to $100 drop in Google in the next day or two. Although with this market, who knows? I do think, though, that could work its way to the channel low. So that's what I'm sort of waiting for with Google. Let's get into some of the stocks you guys wanted to talk about. Let's do the ones that reported here, earnings-wise, so that we can get those off the plate. Let's do Tesla. All right, so Tesla reported. Their number was not so great, but the stock has like a 29% short interest currently. Where's Tesla right now? It's like around 160. All right, so that I see the real breakdown in Tesla coming from like 180, 183. Maybe it can squeeze up to there. There's a gap fill, I believe. I don't know if it's still a gap, but 191 would be kind of like the sort of into that area. The max, what was this low? The flash crash low was 195. So I could honestly make the case that it could squeeze up to there, but there's a lot of supply up there. It really came down very hard, very fast. It went through what I drew in as a channel low. So this to me is a bit of a relief rally. It may or may not have legs. My guess is it's probably going to set up for a short at some point again. With regard to, the platform froze. What an annoyance. I was going to give you the, let me give you the levels. Intraday, 1 day, 5 minute. So the after hours spike high, or the after hours high is 164.90. Anything above that tomorrow will probably continue to squeeze. We'll have to see. My guess is it probably won't open there, and it might just wind up selling off a bit. But above, there is room. Like I said, this thing came down so hard, so fast. There is room to squeeze up higher. So I would be looking for a move over let's just say 165 for it to have some legs up to those 180s and 190s. Anything below there, maybe it wants to come back and retest like into the the mid 150s. Twitter. All right, so it looks like this was all over the place. It had a spike close to 16. It went down to, 1282. And now it's just chopping. I believe they missed by they had their MAUs were down by 2 million users. Not good. They had better, I think a little bit better than expected earnings. They're introducing a bunch of new product features, but this is probably going to just be, here's the question. If you've been long Twitter for a while, are you just giving up here? I've said for a while that this stock could become a single-digit stock. They got to just move faster. They got to get the monthly average users up. I think that this is probably just going to chop for a while, although the good news is if Twitter didn't really go down on that quarter and it doesn't hold, like if it's green tomorrow, you might have a short-term tradable bottom to play against, a regular hours trading low to play against. And if it breaks, the reference low if you want to try it short. So that's really going to sum it up for me with Twitter. So we did Tesla, we did Twitter, just crossing off. We didn't do Apple. All right, let's, Expedia. They reported after hours. Oh, wow, they just missed the 61.8 fib. The after hours low was 82. 81.91 was the 61.8 fib. If you guys don't think these fibs work by now, you're wearing horse blinders, maybe like Janet Yellen. Now it's up pretty big after hours. I'll tell you what does often happen with this is that you get a move in Expedia that translates into Priceline, and then Priceline runs really hard into their print, and then it's a short. So let's see if we can get a bunch of days up in Priceline where it runs hard and squeezes and then sets up for that kind of like a short, maybe like $100 move type of a thing. But there'll probably be a little bit of legs going forward in my guess is in Priceline now into their earnings if Expedia holds up well. It bothers me. I mean, you had tweezers. Wow, I didn't look at Priceline's chart today. I sort of wish I looked at this. You basically had tweezers 2 days ago. This had gotten really steep, and you had a rally. So this will probably have a throwback to the breakdown, which was, it would help if I was on a longer time frame. The reference low there was 1103.45. I want to say, yeah. That was like kind of the last pivot. So you'll probably get somewhere up in close into that area now if they want to run Priceline into the numbers. After hours, it's what is it? Let's see. I bet it's up decently. Yeah, it's up around 1085. So they'll probably run it up into there, and we'll have to see. That could be a good right or right out short play. So that's Priceline. Goldman Sachs. I'm gonna kind of just actually let's do Apple first. Everyone likes Apple, right? Or doesn't like Apple or whatever. Wow, this thing was up almost it was 96.67 pre-market and then closed in the 94s. Wow, what a dump. I think the problem for Apple is that it's a stock that a lot of people own, and it's an very easy one for people. Yeah, could be capitulation. I just saw someone asked about capitulation in Twitter. I'll tell you, that was a pretty piggish. The number was good, the earnings number was good, but the MAUs were bad. So I'll tell you this: there could be some capitulation in that. Like if it didn't go down on that type of a piggish number, maybe it's not going to go down anymore on bad news. When a stock can't go down on bad news, that's usually, this is a little too bright. It got a little dark here, but. You know what, let me just up sorry, we're a live broadcast here. This isn't I don't have an editing broom or booth. I think I'm just trying to get the lighting right. It's getting darker outside. So, all right, that should be okay. Anyway, so I think that's the problem. The MAUs are a problem with the Twitter, but if it doesn't go down, if it can't go down on bad earnings, it probably is going to rally. So let's see how that plays. That could be a trade tomorrow over the opening 5 or 15 minute high, or a short below that low as well. So that's Twitter. I saw a chart today with Google searches or whatever, and Instagram is like overtaking Twitter. So that's really a big problem for them. I've said for a while I think Twitter should try to become a little bit more Instagram-like. All right, so here are some ones that I don't normally cover, but you guys asked about it, so I'll do it. What was I saying about Apple? I was saying that it's a stock that a lot of people own. I think a lot of people also own it from higher, and I think that they're using it to kind of fund margin calls, frankly. The flash crash low in Apple was 92, so I guess as long as it's above that, it's still kind of like, I guess, okay, but it looks to me more like it looks to me like it probably wants to rally to 100, but it also looks to me like it wants to go down to the 61.8, which is 85.72. If it were to go to the primary trend, it's like in the 84s. My guess is that there's going to be some confluence there, and that it will set up. The entire gap fill, if Apple was to retrace, would be to like close to 75. So I'm looking for like another wish lower to sell puts into, if that makes sense, or a rally up to like, let's say, the 50 to just short against. So Apple to me is it's been in this compression pattern here. It stalled against the 20. So I would say a breakout over the 20-day moving average and a breakout over like 97.33. 97.33, 97.34 is a long to 100. If it snaps the low in the 93s, it bounced. It's already kind of tested 92s, 92.39. I don't know that 92 would hold it this go round. So a snap of that would probably take it to 85. So I'm looking now. All right, so let's make it real simple. I think over 97.33 is a right or right out long. below 92. I'm going to even say 93.04. You know, if it loses that 93.04, I would be interested in trying a short. Let's keep it simple like that. All right, so that's Apple. Someone asked me about... Oh, no, you know, let's do LinkedIn. I meant to cover that in the weekend review, and I didn't. That's my bad. Geez, how did I not, right? I remember I was like, I should cover this, and I didn't cover it, and that was, I think that was a big mistake. So LinkedIn is really terrible. The stock, it took out, let's just discuss what it did. It took out its long-term trend line. It took out 166.08 reference low. It took out 136.02 reference low. I mean, it took out 140.10, which was the 61.8. It took out the reference low of 136.02. It took out 122.70, which was the big breakout. It took out the 78.6, which is the 103.10, and now it is coming into a artificially drawn channel low. This is like from that 136.02 low. So I think in the 90s here, like 91-ish, that this may find a little bit of support. 100% retrace. I will say this though, and I don't want to freak anyone out about this, but this really could happen. The entire 100% retracement move is down to 55.98. I'm just going to hang that out there. If we're in a true bear market, that's where it will likely go. There are not much references here other than the artificial one that I kind of drew in for you guys. If you want, you know, I didn't project this onto the you know, what is it they always say? Don't project your worries on me or whatever. Don't project your problems on me. But let's project our problems on LinkedIn. I'm doing this on the fly. I really wish you guys could see this. You know what? I got to get a broadcast one day where I could like work the charts and like draw them in so you guys could follow along live while I'm doing it. How cool would that be? I'm doing something a little crazy here. What is this? 180.42. Just bear with me. I think you'll like what I'm doing. I'm drawing in a 1.618 Fibonacci extension from the last range of this stock, and I'm projecting it down. And wow, that didn't work out right. It's supposed to be 165.57. That would do it. Let's see. All right. Sorry to bore you. All right, so. Geez, we're a little bit below there. That would have been 108.21 that was from the last top. If I do it from the tippy top, it would take us down to, and this I think will be a right or right out long actually. And I may even enter the order like immediately because I think it'll work. All right, so if we do all right, so we're close. We're getting close, guys. We're getting close. The 1.618 Fibonacci extension down is basically right where we are. That is 97.21, and we have the channel low coming in a little bit below at 91. So this is what I think is going to happen. We may overshoot the 1.618 by a smidgen and then rally. So I actually think we're getting close to a tradable low. I'd love this to be like the fifth day of a move down on LinkedIn, and we are on 1, 2, 3, 4. Yes, tomorrow would be a day 5. So if you get a Pukarooski McFaddy down to that between 97 and 91, I think that could be viable for a bounce, at the very least to sell some out of the money puts into for some type of a bounce. So we're getting close. That's my view. I will be trying that trade, frankly, for a right or right out. The big move down has already kind of taken place, so I don't expect too much big gap action there. Someone wrote, kind of rallied, I guess, a little bit. Listen, this thing is down so much. so much so fast. I do believe though that extension, the 97.21 to somewhere in the 91s, I want to say, will be buyable for a bounce. So that's linked in. I'm going to cover that in more detail in the weekend review video, and maybe I'll actually, you know what, I'm going to use this one. I'm going to do the chart live in the weekend review video for LinkedIn. How's that? Maybe I'll do it as a separate video, but it will for sure be done. Wow, it's getting really dark in here. I should have put the lights on. It's just me in a dark room here in front of my computer. Which is pretty much how I trade, but that's just kind of how it is. All right, so I could get up and turn the lights on, but I think we're going to be over in a couple of minutes. So let's kind of just run through a couple of more here quickly, and then we'll wrap it up. So that's LinkedIn. PayPal, someone asked about. This isn't one I cover a lot. They rallied pretty solidly on their number and now gave it all up and filled the gap. I've been thinking that this thing was going to be a long, close to the 30s. This is really going to be, it's a young chart. We all know what happened. They broke it. They kind of went in with LinkedIn. I'll tell you this: if you want to be long against 30, go for it. That is your stop. If you break 30, you really got to flip short on some type of, I don't know, horizontal breakdowns are really hard ones to pull off, but I think below 30 is going to probably go much lower. So if you want to be long, it's got to be against 30. Maybe sell some puts. That would be my my way to play that. Gold. Someone was asking about gold. Did somebody say gold? So gold is into not the long-term channel downtrend, because that would be like up around 136. But I have to draw this in here. I think we're either at or close to a, damn it. I hate drawing these things in because the snap mode is supposed to snap, and it doesn't always make it so easy. So we are basically into the downtrend line here. It doesn't surprise me that we're getting a little bit of resistance. It's come up a lot fast. I would say we are over the last swing high. This is really looks like this is obviously a U bottom. I would say, and I'm probably going to wind up, I'll be told, I'll be pillared for this, right? If there's a pullback to the 200 MA, that looks like it was resistance the last two times. It tested above there, but then wound up failing. I would say somewhere around the 200 MA, particularly if it bends and it's sloping up, which it looks like it's starting to do, would be a buyable pullback low for RoRo. Let's keep it simple. Simple. That's GLD. Goldman Sachs, I discuss in my weekend video. If you want to watch that, that to me is a really, really ugly chart. It was a head and shoulders breakdown. It really had the follow through. I have to do a projection on that of where it would kind of end to. Point-wise, I don't have that here, but I will say this. We're getting close to primary trend in Goldman Sachs. If it were to happen like tomorrow, that would be actually a 50% fib around the 133, so I think that would be viable. There's also a reference low around 137, so I think in that area you could probably buy for RoRo. If it snaps there, you want to be GTFO, but I would be an interested buyer on that primary trend, at least for I'd start it as a day trade and maybe turn it into a swing trade. Oh, all right, so let's end on SPY. Thank you for the reminder. I wouldn't have forgotten it, but I do think we should end because it's getting kind of crazily dark in here. All right, so SPY was a naughty monkey today. It's the year of the monkey in China, right? So we're going to use that. We rallied up, and we really rallied up to like there were multi-day hammers. You basically had 1, 2, 3, 4, 5 days of reference lows. We basically got to where the breakdown took place on 2.5, the body of that checked back to there and then kind of dumped. We also basically got to these were old reference lows and dumped. We closed below the prior day's body high and the prior 2 days bearish. I mean, the market looks bearish. I'm sorry, the SPY looks bearish to me. It looks like it's It looks like it wants to go, still wants to me, looks like it wants to go lower. If you can negate today's high, I think you can get a squeeze higher up to the maybe 190, but a snap of that hammer of, listen, below today's low tomorrow, and if we snap the 182s, it looks to me like we're going to want to retest into the 173s, which is a reference low, and very close to the primary trend line, which if it happened tomorrow, I don't know that it will, would be in the 174s. So it seems to me like we're going to go somewhere between the 173s and 175s. I would say if you want to be aggressive, you could short below today's low tomorrow, and then you would probably be looking to press it if we snap the 181s for a row press. That would be, to me, that would be a pretty nasty cascade lower. Anyway, we'll leave it there for now. Like I said, if you caught this video late and you want to watch it again, or you want to, wow, it really did get dark in here. This is a pretty unorthodox video. I'm trying to put some lights on. If you want to see this video on YouTube, it's Justin Pulitzer Trades. That is my YouTube channel. You can see it there. Follow me on Twitter. My handle is @JustinPulitzer. And be sure to leave some comments. I always like some feedback, how to make the video better. Anyway, that's my story. I'm sticking to it. I'm sorry I forgot to turn the apartment lights on, and I'm just huddled in front of a computer screen here. Anyway, guys, let's have a great week and use the levels, and cheers.